Question 1. Which of the following sell transactions is not subject to the holding period restrictions specified in SEC Rule 144? Stock acquired on the exchange by corporate affiliate, unregistered stock acquired by corporate affiliate in a stock option program, unregistered stock acquired by a non-affiliate under an investment letter, stock acquired by a corporate affiliate under private placement. The answer is A, stock acquired by the New York Stock Exchange by a corporate affiliate. And this holding rule, Rule 145, applies only to unregistered stock, which may or may not be controlled stock. So it seems like the question is all these things had unregistered stock and this one didn't. And then also private placements govern the rules. A client is considering the purchase of ADRs, looking to diversify her portfolio, which is not a feature. I think we had this one before. B, not subject to exchange or currency risk. Which of the following statements about dividends and common stock is not true? A, dividends represent a prorated distribution of corporate profits to shareholders. B, only those owners of the stock on record will receive the dividends. C, corporations are contractually obligated to pay dividends. D, dividends may be paid in cash, property, or stock. So it's pretty easy one. C, they're not obligated. It's always optional or their decision on if they're going to pay dividends. Corporation would like to offer their employees opportunity to participate in future growth of the company. Among the methods you may see are employee stock options, subordinated debentures, voting trust certificates, preemptive rights. The answer is A, employee stock options, which is one of the most popular ways to increase in the value of an employer stock. Which of the following statements regarding preemptive rights is true? Both common and preferred stockholders have the right to subscribe to a rights offering. Neither common nor preferred stockholders have the rights. Preferred stockholders do not have the right to subscribe common stockholders. So preemptive rights, where you can keep your percentage ownership before they issue more stock, only goes to common stockholders, not preferred. So the answer is C, preferred stockholders do not have the right for rights offerings. Which of the following statements regarding ADRs are true? We did this one before. 1 and 4, domestic banks and foreign investor. Investor may expect to receive dividends from a warrant, a call option, a put option, or an ADR. Answer is D and ADR. 100% stock dividend, which are true? The share price is reduced by half. The total market value of the outstanding stock decreases. The total market value of the outstanding stock may increase or decrease as a result of the split. The number of shares doubles. A 100% stock dividend. So the answer is C, 1 and 4. Stock price is reduced by half, number of shares doubles. And it says, explains down here, in 100% stock dividend, the number of outstanding shares is doubled and the price is reduced by half. The total market value, market cap, remains the same. You probably knew that one already. Another question on ADR. Not true. Dividends are declared in a foreign currency, so there's no risk. Denominated and paid in US dollars, because ADRs are traded on exchanges, they are relatively liquid. May surrender in exchange for shares. So B, C, and D are all true. They're always going to have some risk, so that seems to be a common thing in the questions. But it's false that they're declared in a foreign currency and that the risk is eliminated. So there's always still going to be some risk. One of your customer owns 300 shares of 5% 100 par cumulative preferred stock issued by NAR. The cumulative feature provides that A, customer has 300 votes times the number of directors and can vote in any manner. The annual dividend is $5 a year. All unpaid dividends arrears must be brought current before interest be paid to their debt holders. All unpaid arrears must be brought current before it pays their common stock. So the answer here is D. The reason why it's not C is you're still behind the bondholders, but you do jump in line in front of the common stockholders. And this is cumulative voting and things. So that's what it says here. Don't confuse the cumulative feature with the cumulative voting that applies only to common stock. Next. An employee is offered a non-qualified stock option with an exercise price of $20 per share. If the option is exercised when the current market value is $30, the employee, this is talking about tax. Now, it's taxed on $10 per share as if it were salary. It's taxed on $30 per share if it's salary. Has a capital gain of $10 per share. It's taxed on $20 per share if it's salary. The answer is A, is taxed on $10 per share as if it were salary, so non-capital gains. And for non-qualified is the key here. In the case of non-qualified stock options, the difference between the strike and the current market value is considered salary and not capital gains. Which of the following have equity positions in the corporation? Common stockholders, preferred stockholders, convertible bondholders, mortgage bondholders. So the answer is not either of the bondholders. It's this is a unique one where it's actually 1 and 2. Common stockholders and preferred stockholders, they have equity or ownership. Bondholders are creditors, not owners. One of the features of convertible preferred stock is that A, the owner has the opportunity to convert this into the issuer's bonds. B, the holder is able to select the conversion price. C, the owner has the opportunity to participate in the growth of the company. And D, the dividend is paid above all other securities. So they are ahead of some people, but not all. So D's not right. They don't pick the conversion price. And they get the issuer's stock, not bonds. So the correct answer is C. The owner has the opportunity to participate in the growth of the company. Which of the following is a risk faced by investors in foreign stock that is not found when in domestic issues? Business risk, market risk, credit risk, or exchange rate risk? Pretty obvious exchange rate risk comes in when you have two different currencies involved when you're in the foreign markets. An ADR is a certificate representing ownership of foreign security that's on deposit in a U.S. bank. That one sounds pretty good right away. It's deposited in a foreign bank. That's not right. A document with interest rate swaps. No. A type of derivative used to speculate. No. So it's a certificate representing ownership of a foreign security in U.S. banks. A company that has issued cumulative preferred stock, A, pays the preferred dividend before paying the coupons of its outstanding bonds. Always behind the bondholder. Pays past and current preferred dividends before paying dividends on common stock. That sounds promising. Pays the current dividends of the preferred, but not the past dividends. That's wrong because of the cumulative. Forces conversion of the preferred that is traded on a discount to par, thereby eliminating the need to pay past or future dividends. That sounds more like callable. So it's B, pays past or current dividends before paying dividends on common stock. Which of the following statements about equity securities is not true? Preferred stock is an equity security while common stock is a hybrid. That sounds like it's not true. Those things are reversed. But let's look at the other ones. Common stock is less sensitive to interest rate risk than preferred stock. Preferred stock is usually non-voting. Preferred stock pays a fixed dividend. So preferred stock is non-voting, so you can cross that one off. Let's see what it says down here. They're both equity. Common stocks never referred to as a hybrid, so answer A is correct. What makes the other ones wrong? There is a fixed dividend on preferred stock. The shares don't have voting rights, and the price of a common share generally doesn't fluctuate with changes to rates as the same manner as that of preferred stock. So preferred stock is going to be more sensitive than common stock. Which of the following statements regarding foreign investments are true? 1. Foreign financial markets are more efficient. Most foreign investment entails foreign exchange risk. Adding foreign issued securities to portfolio provides the greatest diversification. Foreign security markets are more highly regulated. So it's a little bit Wild West, so I'd cross off 4. I wouldn't say they're more efficient. U.S. has a lot more tools. I'm thinking 2 and 3, which would be, nope, no answers. So I wonder which one. So it looks like, the correlation coefficient knocks this off. Because when it has a 1.0 correlation, it means it moves exactly with the U.S. market, and that kills diversification. So it goes down to 2 only, which is they still have foreign or currency risk. So the answer is A. So that is that.